In our last episode, we discussed the most cliche word in macro, uncertainty, in the realm of policy, geopolitics, and economics. Today, we're going to talk about how that's showing up in markets. For most investors' working lives, they've operated within a relatively stable framework. Economic cycles followed a familiar rhythm, asset classes usually behaved in predictable ways, and shocks, when they happened, were treated as external disruptions. It's sort of over here somewhere. Today, what used to feel exogenous increasingly seems embedded within the system itself. The call is coming from inside the house, if you will. A pandemic, inflation, bank failures, 2 major wars, and an upending of the global trade system, all in 6 years. If once is happenstance, twice is coincidence, and 3 times is enemy of action, what's the saying for 6 times? Regime change? That raises a fundamental question for investors. How do you build a portfolio for the less predictable world now at our doorstep? And critically, to avoid falling back on the assumptions of the past. One answer is diversification, and the idea that relying on the simplistic portfolio construction adages traditionally used will no longer cut it. Another is concentration. Focus your energies on only those few opportunities where you have a true edge. These are opposing but not necessarily mutually exclusive approaches. Today, we're going to dig into how those philosophies show up in real portfolios. Scott Burr is a senior portfolio manager here at Future Standard. He runs a liquid alternative strategy that invests across asset classes and merges these 2 philosophies together, spending each day navigating this environment on behalf of investors. Scott, welcome to the podcast.
Thank you for having me. Great to be here.
And as always, I'm joined by my colleague and partner in podcasting, leader of our investment research efforts here at the firm, Senior Vice President Andrew Korz.
Happy to be here, Alan. Excited for the conversation.
Yeah, really looking forward to having Scott today. As we talked about in the intro, blending these kind of 2 approaches, diversification, and then kind of focusing on areas where that informational advantage sort of lies. And then against this macro backdrop of sort of regime shifting, more frequent shocks, it's almost like we're putting out the bat signal for, a superhero. And, like all superheroes, I mean, most have a great origin story. And I'm curious to sort of hear yours, Scott. How did you get interested in investing and sort of get started in the business?
Yeah, I don't know about that, but it's not quite a Batman origin story. But I was born and raised in New York City, and I guess I haven't made it very far because I'm still there. But growing up, we used to get the New York Times delivered every morning, and for some reason, I used to love going to the business section. To the back pages, they had the list of all the stock tickers, and they're all in tiny font. And I used to comb through them and just be curious about which stocks were going up, which stocks were going down, and why. And my folks thought it was actually pretty strange because they were never involved in finance or markets. But then, in middle school, my father put $1,000 in an E-Trade account for me. And, after a lot of analysis, I figured out that computers were going to be a big deal. So I bought.
And this is what year?
Yeah. This is we're call it 92.
Oh, okay. All right.
Yeah. So I just I was reading the tea leaves and computers stood out as an opportunity. So I bought Comp USA, which is like the big computer retailer. My first trade. I think it turned out pretty well. It did end up going bankrupt, but I was long out of it.
Computers turned out well.
Yeah, computers turned out well. Yeah. Go figure. But yeah, the rest is history. So I think E-Trade was definitely part of the origin story. But later in life, I went to a very competitive public high school in the city called Stuyvesant, Math Science High School. There's 800 kids in a grade, and the average SAT score is 1450. And every year, and you could have 7 colleges, and every year they would publish a list of each college, how many people applied, how many people got in, and they told you the lowest grade point average accepted to that school. So it just made super smart kids even more competitive.
Yeah.
But that was a really good training ground for a life in markets because, once you realize or you're in an environment where you're not the smartest kid anymore, and that's not an edge, you need to really figure out how to operate differently to distinguish yourself. And I think that sort of is the same exact sort of parallel to markets where, you talked about edge. What's the edge? Again, it's really hard in such a competitive space like markets to have a durable edge of just intelligence, making smart decisions. For our strategy, and in general, my investment approach, it's having a variant approach that develops a variant perception that allows you to have a durable sort of, acceptable outcome. But yeah, I would say that definitely my upbringing in terms of my schooling and things like that definitely has served me well in terms of the career path that I ultimately took.
So bring us into your seat here at Future Standard. You operate a multi-strategy hedge fund focused fund, and it solves for unique problems that investors have in their portfolios. I'm interested in your view. What is the problem that a multi-strategy hedge fund seeks to solve, and broadly, not just the your strategy and your sort of application of that variant perception, which I love as a concept. But sort of the liquid alt space in general.
No, absolutely. I mean, I think what you touched on in the beginning in your intro is spot on in that what's worked in the past, I think, is very unlikely to work in the future. And specifically, the 60-40 portfolio really has anchored everyone's portfolio for such a long time because it sort of achieved return, but also had balanced risk properties because the 40 diversifying the 60 and whatnot. And I mean, you may not have needed sort of liquid alts or hedge funds when the 60-40 is just kind of delivering in spades. And I think part of that environment when the 60-40 was working so well, hedge funds sort of just became levered bets on risk, right? Because that was sort of the trade. But the real premise of hedge funds, the name hedge funds, is really to kind of be more all-weather diversifier and offer something different than what the 60 and 40 is, which is equity beta is the central risk, and then bond beta or duration or interest rate sensitivity. And I think everyone, if you're a student of portfolios, your goal is to deliver a balanced profile and deliver risk-adjusted returns. And so when you only have the 60 or 40 to choose from, that's limiting. And so there needs to be a kind of third leg of the stool. I mean, you could say cash is a leg of the stool, but cash is not appealing the vast majority of the time. There's no risk associated with it. There's no real outperformance associated with it. So, there's so much room for this third leg of the stool, this alternative exposure, that the intention of that in my mind is to really be a different species than the 60 or the 40. So what that means is it needs to really load on alternative risks and return. And the reality is in this space of alternatives, there's still things that are called alternatives that do load principally on equity and bond risk. But for our strategy, like we are very focused on this problem and being a solution to that problem. So it's very oriented around limiting bond equity and bond beta, and to really focus on making sure that the majority of our risk and return is coming from an alternative flavor. And 2022, I think, is kind of the canary in the coal mine for our portfolio is resilient to scenarios when the 60 and 40 go down. together? The answer is no. I mean, I can imagine there's so many individual portfolios out there that looked at their statement in 2022 and looked at all their different line items.
Yeah.
They thought they were diversified. There's not one line item that's sticking out that's green.
Yeah, where is it?
There's not.
Where's the help?
Yeah,
Yeah.
There's that. Yeah, where's the help? And so, I think that's. I don't think then you're obviously not balanced across a range of different scenarios. And, it's easy, I think, everyone's conditioned by the recent past, and you could define recent, but it's been a great run for equities. I mean, no one can dispute that 10, 15 years,
Sure.
amazing returns. So, it doesn't feel like you need diversification, right? But if you're a student of markets, there's the counterfactual exercise of what happens if this didn't happen or this didn't happen. There's so many markets out there that had lost decades. There's the U.S. equity market, I think, from 2001 to 2010, was basically, it didn't eclipse its all-time high for 10 or 12 years post the dot-com bubble. So there's periods of time where you look at rolling 10 years returns where the equity market doesn't deliver. So I think, the present moment that you described, I mean, the goal in investing is to be forward-looking. A lot of the strategies and positioning and allocations are geared towards what's worked in history. And I think the go forward is going to be a lot different, to be honest with you.
Maybe just to sort of level set for our listeners, we mentioned the fund that you run is sort of a multi-strategy. You invest across different asset classes, different types of investment products. I think most people hear multi-strategy, right? It's kind of the hot term in hedge funds right now. They probably think of, the famous ones. I'm not going to name names, but, pod shops, right? You're sort of got all these different, small teams that invest in a certain area of the market, certain asset class, and you put them all together and you put a risk overlay on top, and that's sort of delivered really, really nice performance, risk-adjusted performance. Those, platforms are massive now. They represent, I'm not sure what percentage of float or of trades every day in the market. Yours is a liquid alternative fund. How is it similar or different to some of those platforms? Are you looking to deliver similar outcomes in a more liquid wrapper? How do you sort of position what you're doing in sort of the liquid alternatives world within the broader investment landscape?
Yeah, as a starting point, I think just structurally, obviously we have more limitations from a leverage perspective, from a fees perspective. We're trying to be a low fee provider of alpha. These pod shops are kind of notorious for the fee load, and they deliver the returns. So it works for many investors, but they're hiring teams in every market, and
Sure.
it's a costly endeavor. And I think the beta piece as well. I mean, I think they're probably more relaxed in terms of their levels of beta than we are. They have a performance fee dimension. We don't. So it's we're not just trying to kind of load beta in there because beta does typically deliver the return potential. We are trying to kind of be a solutions provider to the earlier discussion that we had. So objectives, I would say, are they rhyme. They're not exactly the same.
Yeah.
I mean, they're trying to be all weather as well, but it's tough to be all weather when you have ample amounts of beta, and that's you run the math on that. You have a 0.2 equity beta, 0.3 equity beta. It's the most of your risk is going to come from equity beta if you just scrub the numbers. I think we're playing the same game, obviously, and the game of multi-strategy investing, as you kind of alluded to, is a game of risk return where you have enough diversification that the risks cancel each other out, and you're collecting the return side of the equation. To win that game, my simple sort of model is it's a game of breadth and depth, right? So breadth is really access to all the markets that exist, and that you can kind of source interesting opportunities from,
Sure.
and also have a breadth of kind of techniques to kind of generate alpha within those markets. So you need to have a wide net. And then depth is really kind of the skill and expertise and domain knowledge required to extract alpha in a durable way from each of those markets. So we're playing the same type of game in our strategy. We're solving that equation. So I think we need to be a little bit more selective about where we want to lean into in terms of a market, in terms of a alternative strategy, right? Which kind of hedge fund strategies make the most sense for, the present moment, or at least, the medium to long term, actually, like what are the most attractive strategies. We evolve the portfolio to lean into those strategies that we think have the most durable opportunity set. And I think that's different. I think they're just trying to make sure that they have exposure everywhere and alpha generators everywhere. And so, ultimately, it's a very similar exercise.
So I am curious, kind of dovetailing off that. I mean, you just described a strategy that is very different from, I think, when people, might watch TV shows or movies and see, sort of different types of investors, I think, that are represented in those types of mediums. I've known you a long time. Yeah. You're a thoughtful, circumspect, I think, methodical type of guy. I don't know if you disagree with that. I think there's a lot of different ways to succeed at investing, right? And, I think when you meet enough people in this industry, you start to realize that, like, it's not about being one type of person. It's more about understanding your sort of advantages, inherent advantages, and also your weaknesses, and sort of, molding yourself into the type of role that fits that, right? So I'm curious, for this specific type of investing, I guess when you realize that your sort of personality fit that mold, or if you still question that sometimes.
It's sort of like the variant perception, that Scott mentioned earlier, and Mike Kelly, when we had him on, spoke about at length as well too. It's sort of like that dovetail of like, what is that edge?
Yeah, know thyself, right?
In terms of personality, I mean, and you're probably into it a lot about the investment style and approach from that. I'll leave you with a few data points. So I'm the type of person, and I'm curious if you guys are as well, I will always go to fill up at the cheapest gas station. Like, it's inexcusable. I mean, it's not about the $7. Yeah. It's probably 10 now, by the way. Yeah. These days. But it's just about a kind of a principle. Yeah. And my brother will make fun of me about that.
You feel like you've won the transaction at that point.
I'm just like,
you've extracted some alpha.
It's alpha. I mean, it's a risk return situation. When the second data point is when we moved from the city to the burbs and we're looking at houses, I found this tax arb where if you live in a townhome, you pay basically half the tax from the same priced freestanding house across the street. Okay, because of the tax classification. Yeah. So when I learned that, I said to Stephanie, I said, you know what, babe, I think I'm a townhome guy. I like being around people.
About the classic
I grew up in the city. I just like being around, like, the community. I just, but the tax are expensive. It was just such a good trade. And by the way, I think I bottom ticked mortgages at 2.5%.
Oh, wow.
So that's probably my best trade, to date.
That's a macro trade, though.
I mean, that's
beta.
That's alpha. That's alpha.
That's good.
Then the third data point is that I go on vacation in December. The last week of school, I take my kids out of school for vacation. They're in elementary school, so they're not learning anything. They're not much, at least, anyway. And especially the last week, they were watching movies. Okay.
Reading's going out of stock anyway.
Yeah. Well, handwriting. My wife is worried about my kids' handwriting. I'm like, Stephanie.
Are they still teaching cursive these days?
Yeah. Don't worry about
Take them out of school.
Don't worry about the handwriting.
There you go. Take them out of school.
But you do the math. The same vacation, a week later, the flights are 3 times the price. The hotels are double. It's like, I can't.
And then you future value those savings, I imagine.
I mean, run the numbers. It's just the week before, the holidays. I mean, the last week of school is the best risk return trade there is. So I think to your point on the personality, I mean, you know, in my personal life, like I can't. It's about making quality financial decisions. In my professional life, it's about making quality investment decisions. It's a hard wiring.
Yeah.
You know, and sometimes I wish I wasn't like this, to be honest with you. I'm not saying it's the best way to live, but from an investment perspective, a lot of that sort of, you know, and it's funny with ChatGPT, you know, and AI these days when you're conversing with it, you know, it gets to know you, right? So it's, you know, it really draws you in. And whenever I talk to ChatGPT or ask a question, it'll be like, well, because you're such an analytical person, like, let me break it down to you this way. I'm like, they know me.
It's like,
you know?
This is very you. And I'm like, who?
Exactly.
I don't even know.
But
who
it
that
is. No, but they're right. They're right.
Who are you to say?
Yeah.
Come on.
You know, they're spot on. So, yeah, I mean, I think how that translates into investment decisions. I mean, I'm very risk return oriented, as you might imagine. You know, making sure the math computes. You know, philosophically, in the big questions, when you look, you know, you think about big investment philosophies out there. I kind of view it as the Ray Dalio on one side, which is sort of a believer in diversification. He calls the Holy Grail as a portfolio of 10 to 15, you know, uncorrelated return streams. And then you have, you know, the Buffetts and that style, which is like you want concentrated conviction. That's how you
Where's
make
your edge.
That's how you make your money. I'm more on the Dalio camp because, you know, the diversification math is just too factual, too powerful. Like, I don't know, are you guys CFAs? You know, if you
soon to be over here,
soon to be CFA,
Sitting in August for level 3. So.
Okay, well, you could tell me if it's in level 3 or level 2, but you do the math of you have, you know, 2 assets in a portfolio, the same volatility. If they're completely uncorrelated to one another, the risk of that portfolio goes down by 30%. You add another asset, right, and completely uncorrelated, the risk goes down by another 15%, right? Like, that's just math. And so, you know, did you learn that?
I haven't gotten to that section yet. I have 3 months.
You need to study harder, dude. Come on.
It's the closest thing to a free lunch in finance, I would say.
Thank you. Yeah. So that's I learned that early on. It's the only free lunch. So I have to. I believe in that in that principle strongly. And lastly, I'll say just in terms of making quality, you know, sort of investment decisions. One of the sort of hardships of managing risk is sort of, you know, especially when you're really analytical, is sort of analysis paralysis. Like, at some point you need to be decisive and make a call. And I think I struggled with that early in my career for sure. But then I came across, you know, Howard Marks and his quote, which is that you can't judge the quality of a decision by its outcome. And that was the most freeing sort of investment philosophy I ever heard, because at the end of the day, you know, in this seat, it's about, you know, you're operating in a world of uncertainty. You could have exposures, you do all the analysis, it's a home run, and it doesn't work out. Things change, but if you at the end of the day, if you have a process of making quality decisions, and you have to make a lot of decisions, like, quality decisions will compound into good outcomes. Not every decision, but law of large numbers, that works out. And so, yeah, the whole approach is just about collecting quality decisions across a breadth and depth model, if that makes sense.
It's a very process-oriented approach, it seems. I mean, you know, folks love, like, when Nick Saban talks about, you know, coaching aphorisms and how they think about, you know, achieving greatness during his tenure at Alabama. And it was all about, like, guys, don't watch the scoreboard. What you're doing right now, do that to the very best, whether you're up 40, down 40, or somewhere in between. That resulted in them not being down 40 very often.
Easy to say when you're Alabama.
Exactly. Good recruits help. But, you know, when you think about, like, the mandate of a multi-strategy hedge fund being absolute return, and, you know, when most people think about investing, you know, they think about what does the future look like and trying to predict that. Like, that's where the informational edge comes from. And, you know, when we think about, like, the past regime of economic cycles, sort of more aggregate demand related, where it was like, okay, I know I'm on this continuum. It's a question of what inning of the ballgame are we in, like how far along in the cycle, and that'll inform some of my positioning. But you're following a pursuit that is expressly, not that, because we don't know exactly where we are in the continuum. And when you're going through a period like today, maybe it's a different continuum entirely. Maybe it's not the same framework that you've been making decisions on for the past 20 years. And so, when you're explicitly not trying to forecast the future or stick to that like simple prediction along that, kind of aggregate demand continuum, what are you doing? I don't mean to sound like, what would you say you do here, Scott? But, where does your edge come from and how is that really applied?
Yeah, I mean, I think you're right. The crystal ball approach to investing is tough. I mean, I think some people have skill in really sort of identifying, outcomes before they occur. It requires a lot of conviction, for sure. I just can, a lot of prognostication, I can really see both sides. I mean, that's part of, the struggle in general is I can create a bull case and bear case for just about anything. And so, and to sort of crystal ball invest, you really need to have conviction in one outcome. That's not how I'm wired, frankly. But the beauty of multi-strategy investing is that it's not required, because it goes back to the breadth and depth point. Is that if you're able to access exposures across markets and instrumentation, and you can organically determine in each of different buckets, what's interesting to do at a given time based on kind of the endogenous variables that kind of guide risk return in those markets. And when you kind of go through different markets and cherry pick what's interesting, a lot of times what's interesting is actually not the sort of same-sided exposures, right? So I'll give you an example. Like in the equity market right now, it's obviously AI, all the action. There's a lot of momentum. You kind of what's working are the cyclical names that are CapEx beneficiaries, right? So you might say, okay, this is an attractive sort of tailwind to participate in. You look at a market like volatility, and you look and you say, well, what's sort of most unusual is just the level of dispersion that exists in the cross section of markets. There's just so much dispersion, and so correlation as a parameter that you can sort of take views on is very cheap. Yeah. So you can like position for an increase in correlation back to some historical norm. Positioning for correlations to go back to a historical norm is extremely cheap, because there's this belief that this dispersion environment is just going to persist for so long. And so, you could say, okay, it may be interesting to kind of position for correlation, some normalization. And so, those trades naturally offset one another, frankly. So the point being is, and I could have a number of examples of that, where you pick a specific variable like, the fixed income curve, right? And you could say, okay, well, the shape of the curve, right, it informs a lot about macro. Like if it's a steep curve or a flat curve's recessionary. I could tell you an exposure I love that benefits the most from steepening curves, and I could tell you an expression that's very attractive here that benefits from flattening curves. So it's really about, collecting things that in a vacuum are interesting, but then in the portfolio context, making sure that, there's enough diversification and that you're kind of neutral to kind of big macro outcomes. And you're not perfectly neutral. There's leanings. Yeah. But it's really the multi-strategy approach affords you the opportunity to kind of construct that. If you're just a rates trader, it's pretty hard not to just have a view and whether rates are going higher or lower. Like you can't avoid making that call, right?
And it's when you've got that extensive breadth, it's almost like there's an unlimited number of trades you could make, and different instruments by which to implement the exposure.
100%.
And, you've sort of given a little bit of an example, but I'm curious, like, you've got this breadth. How do you decide which rises to the top and what is like the trade that you want to execute and like go about expressing that in the most efficient way?
How do you filter that world down to something that feels actionable?
Yeah. So, in our strategy, we actually have to make a bunch of different types of investment decisions. And one of them is just what, like I mentioned, with our balance sheet, we allocate our balance sheet to a number of external managers, and there's specific hedge fund strategies, like convertible arbitrage or merger arbitrage or long short credit. And so there, you really have to understand what are the drivers of return for those strategies. What are the conditions where those strategies have above average returns? Convertible arbitrage, for example, the issuance of converts is a big source of return for that type of strategy. Obviously, the amount of risk capital in the space, deal activity is important for merger arb. And so you kind of, for cash flow strategies, obviously the interest rate environment's very important. So those, you need to understand kind of the broad tailwinds for hedge fund strategies when you're allocating to hedge fund strategies. In terms of more opportunistic trades, which is what I spend a lot of time on and what we do in-house. Like you said, it's kind of drinking from a fire hose a bit, because the idea generation, there's so many ideas. The question is, how do you filter through and determine the quality idea, the quality risk return? And there's a few things, and you touched on one of them, Alan, but the first one is what I call signal agreement, which is that you're looking for things where there's a lot of reasons why you're building a case for why this idea should work, and so you're identifying things that drive return outcomes, whether it's fundamentals, whether it's positioning, whether it's macro, environment or catalyst. You're looking for signal agreement across the dimensions or the drivers of return.
So multiple things that, are, hypothetically independent of each other, but that point towards the same potential outcome for this given exposure.
These variables are skewed. It's a checklist. Skewed positive, skewed, like how many checks can an idea get is a simple way to think about it. And, there's trades like in 2022, equity value themes. Like we had a trade where we were long kind of reflation stocks versus non-profitable tech, because it was kind of like a value expression. Because in 21 there was just this sort of growth investing was all the rage. These sort of the Cathie Wood kind of names were flying. Huge valuations, and then you had this inflation shock, higher rate. Everyone thought rates were pinned at zero forever, and that sort of derated all the growth companies. So you looked at that, and it was sort of value spreads that, when you looked at high versus low value, were so extreme, right? Positioning was so extreme, and then you had this macro catalyst of a higher rate shock, right? Like a lot of alignment of signaling. And, there's, you could say that about the mortgage basis, when the Fed switched from QE to QT. Like the home run trades, when you look back and do a diagnostic, it's about this signal agreement. And then the second piece, which you mentioned, is implementation alpha. And I think that's where, frankly, for me, I would say that's my wheelhouse the most, is sort of discriminating against, different ways to express an idea. And if you have a broad toolbox of sort of markets and as well as instrumentation in terms of derivatives and options and all the different types of structures out there to sculpt risk and return, there's so many. That's where a lot of times you can add a lot of value just from how you structure an idea and implement something. And, just as a simple trade on betting that the curve, the fixed income, the treasury curve will steepen, right? You can just buy, the vanilla implementation is like buy the front end, sell the back end, or you can, harvest, dynamics from the vol and skew market and say, actually what makes a lot more sense is let me sell a payer on the front end and buy a payer on the back end, and I have better carry and I have better convexity. It's like, that. There's a lot there, which is smarter ways to sort of construct risk return. And so when you have an idea that checks a lot, has signal agreement, you have an implementation alpha as well. Like those are great trades. And then I also there's not all return is equal in terms of sort of how dependable or deterministic the return is, right? Like there's stuff that's very deterministic, like a merger arb deal. What the price is if the deal is completed, right? You largely know. You have a pretty good idea of downside. Like that's pretty. Those numbers are pretty reliable versus there are returns that are fuzzier math where you think this will happen or that happens. And so, again, in terms of quality trades, the more tangible the risk return, the more that you have a handle on risk return certainty, those are also better trades. So the quality of kind of your risk return estimate is kind of the third piece. And so that's sort of kind of a simple framework, I would say, to how I filter those types of opportunities.
Maybe now we can take that framework and let's bring it to today's market. So I'll sort of give another plug. We released our Q2 economic outlook about a month ago. Did a podcast. Go back and listen to our last podcast if you want. The rundown on that. But our fundamental thesis is basically that we're entering this sort of macro regime. And this is what we focused on because, early April, we had no idea what was going to happen with the war. I think we're sort of still in that environment, but it felt, disingenuous to try to predict what was going to be growth in Q2 or whatever. So we sort of focused on our broader macro framework and how today's market environment sort of fits into that. And I think, the sort of bottom line thesis is like you've got a U.S. economy that's probably, more dynamic, more resilient, less cyclical than it's been in a long, long time, right? And I think it's proven that through all of these shocks that Alan mentioned in his intro. Growth has stayed pretty steady through all of those. You look at earnings right now, right? Earnings in Q1 were absolutely incredible. So the economy looks to be doing okay. But, we're operating in this world where external and unexpected shocks, in many cases supply-side shocks, are becoming more and more common. And I would argue these are not coincidences. These are sort of what happens when you go into a less certain type of global environment, more competitive driven, less sort of efficiency driven, like the one we've been in the past few decades. In that type of world where you do have these more sort of truly unknowable things happening, whether it's a war, whether it's a bank failure, whether it's like, central bank policy, whatever it might be, it feels to me like that might open up more opportunities on your end and more sort of mispricings that you might be able to take advantage of, more deviations from historical norms. But I guess on the opposite end of that, like if we truly are entering a new regime, right? Like and sort of these cross-asset relationships truly are changing durably, then maybe like betting on mean reversion is less reliable, right? So on one hand, I could see this opening up more opportunities for you. On the other end, it's like, how do you manage this risk that like these relationships that you've and we've all relied on are no longer reliable? Like, how do you kind of fit those two things together?
Yeah, no, it's a great question. I think, listen, there's a lot to contend with in terms of market headlines, market shifts, right? You mentioned shocks, geopolitical, obviously AI
policy,
the mid-elections, AI, a transformational technology. We have a sovereign debt bubble globally, right? There's so many things that can impact markets, derail markets, and it's markets also get sort of fixated on one sort of topic and then move on and sort of you need to kind of have a hierarchy of what things are driving markets across asset markets, principally the most, and that shifts over time. So you need to kind of have that in your model. But to your point, I mean, you certainly need to be aware of, I'm open-minded. That's why you can't be dogmatic. You can't be a one-trick pony and say, right. I'm going to just bet on exposures that appear to be dislocated and play mean reversion. I mean, there's so many. Stylistically, you need to be diversified in how you're making money, right? You need to have a portfolio with deterministic sources of return, like merger arb, right? That regardless as to those types of questions, like they're going to have alpha opportunities. And so that's where the breadth and depth of styles and techniques is really important in this environment, because it's unknowable, to your point, how a lot of these market realities will play out at what frequency.
But when they do happen, like the SaaS apocalypse, maybe for example, earlier this year, does that? For what you do, like, does that sort of like you wake up jazzed when that happens?
Okay. No, I mean, it's odd having a strategy that sort of benefits from tumult and sort of fear and
irrationality.
There's just in general. I mean, I love blood in the streets. No, I'm joking. No, it's. The worst environments are like the 2017, like low vol, sleepy, nothing's happening.
Yeah. Right.
Certainly, the environment where there's all these different cross currents is one where I think professional active management kind of proves its value. And when beta is ripping higher, like, what do you need to pay an active manager for? It's just ride the beta train. I mean, I think. The other thing that I would say along those lines is when there's shocks like a Liberation Day or the war. I mean, the one benefit of having a low beta portfolio as well that is not sort of risk on is that when there are those types of shocks, you get to be offensive. You're not licking wounds. Right. You're not risk managing. You're not cutting risk. Those are opportunities to, position for a bounce if you believe in a bounce, and you can do that because you're in a good posture,
right?
Right. So I would say, I think there's a lot of certainly unknowns, but the more things that the market has to grapple with in general, I would say. It's sort of a tailwind for this type of investing. There's no question about it.
Yeah. So I'm curious. You mentioned AI. I'm curious your thoughts specifically here. You probably argue that's a positive supply side shock. We've been talking about negative supply side shocks here, but in general, I mean, not going to say anything new here, but I think if you look at the past 4 or 5 years of equity market performance, even just zoom into this year, if you look at like the drawdown we had in Q1. I think the Mag 7 were responsible for almost 100% of that. If you took them out, the market would have been flat. The bounce since then, which I think we're up like 12 off the bottom now, the Mag 7's responsible for like half of that if you add in like Broadcom and AMD and even Intel. How about Intel getting in the action? That would be like almost the entire contribution to that 12% rebound, right? So you have this market that's just absolutely dominated by AI. We've done some work to sort of add up like the different areas of the market that are like really levered to the AI theme, and it's like close to half of the S&P 500, right? It's basically beta now is now AI beta, right? So, everything we've talked about here, I think would suggest you have no interest in adding more beta to that theme in investor portfolios. But given that it is sort of dominating, the markets we've seen semis this year just absolutely rip, as you mentioned, like. What are the sort of ways that you can play this since it is all consuming? I mean, I assume you have to sort of take, positions within the theme. But what are some of the things that you're doing that are like interesting that don't add more beta, but maybe like take advantage of some of the things that are going on?
Yeah, I mean, Yeah, I love the AI theme. Your premise, I don't know if I fully subscribe to the beta is AI beta idea, because you're right that beta has been driven by the S&P 500 has been in return been driven by the earnings growth associated with the CapEx spend, and there's a narrow group of names that have driven the bulk of the returns. I think it's 40 or 50 like real CapEx beneficiary names. But on the flip side, I mean, maybe this changed this week, but through last week, the median S&P name is down on the year, and so AI at this stage, is a game of, I think, there's winners or there's beneficiaries, at least around the CapEx cycle, and then there's losers, and those businesses that are being disrupted. And so the equity, the beta is up, S&P is up 6 or 7 maybe, but you look at the cross section of semis versus software year to date, that spread is 60%.
Wow.
Yeah.
And software used to be the biggest GICS sector. Now it's semis, and so it's really it's kind of a like the Bezos, your margin is my opportunity, where like Amazon just consumed everyone else's market cap. Like there's a lot of that going on, right? Which is that the CapEx beneficiaries are stealing the market cap of the businesses that are thought to become obsolete,
right?
Type deal. So I think there's a ton of the opportunity in AI is in the cross section of returns, and I think the questions of the day really are around the go forward CapEx spend, and and have taking a view on sort of whether that spend is estimates around future CapEx are too high or too low, because the Mag 7, the hyperscalers at least have been funding, all this CapEx into highly cyclical businesses with huge operating leverage. So that's why they're generating all that earnings growth. But the sort of CapEx spigot needs to continue for that growth to kind of continue. But you look at the estimates of hyperscaler CapEx next year, there's a flatlining, right? And there's a kind of an assumption, and that's why their ROICs are still pretty elevated, and their valuations are still pretty elevated, because there's an idea that they can stop this extraordinary CapEx and then start harvesting the return from the investment. But now we're in a theme of kind of compute scarcity. Like there's less fears of there not being enough demand and AI doesn't work, and it's more around we can't service and meet that demand.
Well, that's the interesting thing, right? It's like on one hand, it's like, okay, like if AI does become as ubiquitous as we think, and that's great for these guys, right? Because they own the infrastructure. But like, that means we're going to need to spend a whole bunch more on inference to provide the compute necessary.
Yeah, well, that's why the hyperscalers it's interesting, right? Because compute scarcity is good for them because they own the compute, and there's a little bit of a RV between for every subscription to a foundational model or lab, how much are they paying the hyperscalers for the compute, and what percent, and so who has the leverage there? The people providing the compute, and so compute scarcity is good for the hyperscalers, but the real question is sort of this CapEx spend and how much they need to spend to make sure that compute is available. For me, the hyperscalers are tough buy until they show that stabilization of CapEx. You see Meta they just keep getting punished by the CapEx spend exceeding expectations. You need to sort of see that level off, or you need to see the return on investment sort of start to be generating. So for me, like the AI trade is an evolution, right? And but it's in the cross section of returns, where you have to when you think about the AI, cake of the different segments of the market, right? You have the energy producers, you have the chips, you have the infrastructure, you have the models, and then you have the applications. Like over time, there's different opportunities in each layer, but you have to be selective, and it's not a set it and forget it. Like, I want to be long AI beta.
There's no AI trade.
There's no AI beta. It's in the cross section, and then there's also other expressions too, right? Like, we are long the credit side of the digital infrastructure build out because, in the equity world, you'd argue a lot of these names are expensive and really are levered to this AI outcome, going down without a hitch. In the fixed income and the credit market, there's huge financing needs, and when there's a lot of supply and new issuance in credit, like, spreads widen out because you need to incentivize demand. So, like, data center, credits in the ABS and CMBS market, they have wide spreads to the same rated paper in the corporate bond market, and so, like, there's real value in playing AI infrastructure in credit. I don't think you can make that case in the equity market. So there's a lot of different expressions in AI. You can even go to macro asset classes to have a view of AI because if you have a view on labor, displacement or productivity, and like, AI is ubiquitous and really impacting, of course, commodities. Like, there's different formats of the AI trade, of course.
What's interesting too is a final point I'll make on this is, like, 2010s were like the decade of, like, the consumer subsidy. I feel like we're now in, like, the decade of the enterprise subsidy because, like, tokens are just so cheap right now for companies, right? And like.
100%. That's a great way to put it.
These companies are, like, losing money hand over fist, the model companies, because they're just subsidizing, right, all the usage by these enterprises. And I don't know how long that'll go on. I think for a while longer, probably. And it's like, what we see in, like, the middle market, for example. As what we talk about is, like, if it's cheap to implement AI and it's really as good as we think it is, and you can really glean the productivity gains, like, that becomes part of the AI trade too, right? So that's another sort of level to this.
100%.
Yeah, it's I was sitting here, kind of smirking because I'm sitting here thinking about, like, the solution to the problem Scott just described as it relates to, like, the AI hyperscalers is, like, just start billing people for the compute usage. And it's like, I can't wait to get my phone bill, then my electric bill, and then my compute bill on top of that.
Token efficiency is going to be the name of the game.
Exactly.
Pass it through.
Yeah. I mean, there's something to be said for pay for what you use, right?
Totally.
So I'm a fan of a toll bridge,
Sam Altman did say...
love a contrarian like that.
Yeah.
The toll bridge fan.
Yeah.
Nice contrarian right there.
All right, so last couple questions here, Scott. Last one for me. As you know, Future Standard, private markets centric firm, I would say. We're not all private markets, obviously. That's why we have you in the seat today. This is a private market centric podcast. But I'm curious from your seat, sort of the way that you see, the strategy you run, but liquid alternatives more generally fitting in with the growing private markets ecosystem within a broader portfolio, right? Obviously, there's the liquidity. There's sort of the daily liquidity in a mutual fund versus the more periodic liquidity in many of the sort of private markets evergreen or a drawdown, which there's no liquidity, right? But, like, how do you think about, like, how they fit together? Like, is there tension there? Is there actually some symbiosis? Like how do you feel like those two sort of worlds fit together?
Yeah, no, I think definitely they go hand in hand, very complementary. When you think about why folks go to alternatives, right? It goes back to what we discussed. There's a deficiency in the beta, in the betas of some sort. And so you're going to alternatives for a solution, right? So the solutions can be growth opportunities, right? Middle market access, things you can't find, directly in public markets. There's income type solutions, and of course the diversification solution, like we talked about today. So I think private liquid and liquid alts. I mean, you have your kind of menu of objectives or solutions, across the spectrum of liquid and less liquid alts. And of course, liquidity is a very important variable and constraint that you need to solve for. So, when you combine liquid alts with private markets, I mean, you can really optimize around in your portfolio what your objectives are, what your liquidity needs are. And then in general, just from an asset allocation perspective, right, it's important to have liquidity in a portfolio so that you can utilize that liquidity to generate a better outcome, right? Because that's what asset allocators should do. They need levers to pull. Everything is strategic set and forget allocations I don't subscribe to. If you do the work, there's always better and worse opportunities for certain investment strategies, approaches, exposures. And so it's important to pair liquidity with illiquidity so that when it's sort of opportunistic to load into some less liquid exposures, you can fund that, from more liquid exposures. Conversely, there's less liquid exposures that can go through periods where they're less attractive. You can source that liquidity over time, and then where do you want to park that? In a liquid exposure. So the idea that an optimal portfolio is all liquid or all illiquid, like it's tough to make that case. It needs to be a hybrid alternative allocation that runs across the full spectrum of liquidity.
So, to close this out, like a constant theme throughout the episode has been diversification, but also then, the targeting element, and like how do you bring that together? And the conversation around that's been terrific, and we're so thrilled to have asked you to join the show today because I think your perspectives align with what we're seeing in the market, the level of uncertainty that we've been talking about for a couple episodes. We've had some really hard macro-focused episodes over the past few weeks, and this is almost like a philosophical question, which is, when you think about true diversification, what is it really that you're trying to provide? I know, I'll make sure to get this right on the exam, which is, 2 fully uncorrelated assets, 30% risk reduction, add a third, an additional 15%. I
can't wait for you to get this question on the test.
I will
just smiling.
Scott Burr in the thought bubble.
Yeah.
If I miss it, that would be a sad day. That would be a sad day. So, but, hopefully quick learner here. But, when you think about, a truly uncorrelated source of return, like what is that? Like diversification's catch all. Like sure, it can be quantified in the ways we just did, but what are the tangible outcomes it could provide for investors? It's obviously the compounding at a less volatile rate of return, but like it also gives you real options within a portfolio with what you're looking to implement.
Yeah, I mean, the tangible outcome is risk return, and I think the problem with diversification is a lot of the stats that people talk about, like they don't really resonate, like Sharpe ratio. No one actually, like volatility isn't necessarily a bad thing. Yeah. So solving for return over vol, it's not, is that tangible? That's just kind of, quant finance talk. When I think about risk, I don't think about vol. I think about losing money. Any investment, going back to quality decision making, it's any investment decision anywhere is about how much can I make, how much can I lose. How much can I lose is not volatility. I mean, it rhymes with volatility, but it's not that. It's drawdown. Yeah, it's how much loss do I have to stomach, mark-to-market loss. And so the objective adding diversifiers to your portfolio is to enhance return and reduce loss and change that skew. And part of that's from the product itself delivering return when the other things aren't, but also having that lever you can pull in an asset allocation perspective that allows you to take advantage of opportunities on the beta side, and just that also is additive from a return perspective. So there's a lot of ways to manufacture excess return when you have a balanced portfolio. But more practically, I mean, it's about curtailing that drawdown. And when you look at equity markets, I mean, the great run, but you've had to live through a lot of tumult in the past, good
6 years. Good luck holding your water through that.
Yeah, no, I mean, it's like, and the emotional side of investing, you wake up and your portfolio is down 10, 15, 20. Like, that's really tough to stomach. You can make bad decisions. And so ultimately, when you have a balanced portfolio, it's peace of mind. You sleep better at night because you're not you're not fearful that one day, you have to stomach a double-digit drawdown in your portfolio. And I'll leave you with a funny story. When I first joined Future Standard, I guess this is 9 years ago, and I was kind of talking to some of the distribution folks about the strategy and diversification. Diversification was kind of a new kind of concept, that solution for us. And I was going through, sort of these CFA laws of of diversification and correlations and betas and I looked around the room. It was like the dinner party story I told you. It was like
Trainers, Sortinos, Omegas.
Yeah.
They're running through my head
Glazed.
like a ticker right now.
Yeah. So glazed eyes, and one of the guys looks at me and goes, "So, are you saying that it's going to be there for you when you need it to be?" And I was like, "Yeah, that's it's there when you need it, you know." And there's some truth to that, which is that, you know, diversification. There's certain times, right, when beta's ripping, where you're kind of like, "Oh man, if I only just didn't have this diversifier," like. But then when it shows up, you know, the 2022s, when you have that line item in your portfolio that's up and everything else is down, you know, it's a powerful thing. And again, in the go forward environment, I don't know if we're going to have, you know, you look at the PE ratio, you know, there's a famous chart about like what's the 10-year return when PEs are 22, 23. Like, you know, in those environments, I mean, I think, again, what strategic allocations are there out there for investors? Not a lot. So I think these types of strategies are certainly paramount in the go forward.
Be there when you need it. I think that's the takeaway.
It's like a nice blanket.
Scott Burr, thanks for joining the show.
Thank you for having me.
Thanks, Scott.
Appreciate it.